When a business owes back taxes, the issue isn't the balance, it's what the IRS is allowed to do next. Once taxes go unpaid, the IRS isn't focused on the number, it's focused on enforcement authority, what they can reach, what they can disrupt, and how quickly they can apply pressure to force compliance. That's why two businesses can owe the same amount and have completely different outcomes. One keeps operating, the other gets its accounts frozen, payroll interrupted, or revenue streams cut off with very little warning. In this video, I want to explain what owing back taxes actually means from the IRS's perspective, how enforcement escalates once a balance exists, and why the real risk isn't the debt itself, it's how long you wait before understanding what the IRS can legally do next. What owing back taxes actually means. Back taxes are not defined by the amount. Back taxes begin the moment tax is assessed and unpaid. Filing does not equal resolution. Payment status matters more than compliance optics. Interest and penalties are signals, not the problem. Back taxes aren't about what you owe, they're about how the IRS classifies your account. Why are businesses treated differently than individuals? Businesses are operational entities. Enforcement tools work faster against businesses. The IRS prioritizes business bank accounts, receivables, payroll streams. There's no court approval required for many of these actions, and speed matters more than fairness. The IRS doesn't need to prove anything to disrupt the business, it just needs access. So how back taxes quietly escalate inside the IRS? The initial balance due notices feel passive. Each ignored notice changes internal posture. The case moves from reminder to collections fairly quickly, and automated pathways begin forming. Human discretion decreases over time. Nothing happens all at once, and that's what makes it dangerous. The most common business owners' misconceptions are, we're still filing, so we're fine. They haven't done anything yet. We'll handle it when cash flow improves. Our CPA said it wasn't urgent, and they confuse silence with flexibility. But the IRS doesn't interpret silence as patience, it interprets it as non-cooperation. And that's why timing matters more than the amount owed. Each action preserves options. Late action forces compliance. The same debt has different outcomes at different stages. Leverage exists before enforcement, not after. And once disruption starts, your choices begin to narrow. The danger of back taxes isn't the bill, it's when the IRS decides it's time to act. This isn't a bookkeeping issue, it's not a math issue, it's a collections and enforcement issue. Your decisions here affect cash flow, operations, future audits, and escalation speed. If your business owes back taxes and you're not sure how far along the IRS escalation process actually is, that's not something you should guess on. We offer a free call to assess whether your business still has leverage or whether enforcement is already forming. You can book that using the link below. Now, why is waiting making this worse, not better? Delay feels rational. Delay feels responsible. Delay feels non-confrontational. But delay changes nothing inside the IRS. By the time urgency feels real, your leverage is gone. Waiting doesn't preserve options, it quietly removes them. Owing back taxes is only one way the IRS starts paying closer attention. But what many business owners don't realize is that certain patterns, even when returns are filed, quietly increase audit risk long before any notices arrive. In the next video, I'll walk you through the most common IRS audit triggers for businesses, why some returns get flagged while others don't, and how seemingly normal decisions can draw scrutiny without you realizing it. If you want to understand what actually puts a business on the IRS's radar and what doesn't, that's the next thing you should watch.